Hi everyone, welcome back to our channel. Have you come across the term Bitcoin ETF? Well, let's embark on a journey to understand this fascinating concept. We'll start with the basics. Bitcoin, the first and most famous cryptocurrency, is a digital form of money that operates independently of a central bank. Now, let's introduce you to ETFs or exchange-traded funds. In the simplest terms, these are investment funds traded on stock exchanges, much like individual stocks. They offer a way to invest in a range of assets without having to buy each one individually. So what happens when we merge these two concepts? We get a Bitcoin ETF. In this video, we'll dive deep into the specifics of Bitcoin ETFs, exploring their inception, benefits, and potential drawbacks. Are you ready to unravel the mystery of Bitcoin ETFs? Don't forget to like this video, subscribe, and turn on notifications so you never miss out on informative content like this. Before we delve into Bitcoin ETFs, it's crucial to understand Bitcoin itself. Imagine a form of digital or virtual currency, unlike the physical coins or bills in your wallet. This is Bitcoin, a revolutionary technology birthed in the year 2009. It's like an online version of cash, but with a twist. Bitcoin uses peer-to-peer technology to facilitate instant payments, allowing transactions to occur directly between individuals, without the need for a middleman like a bank or credit card company. And here's the kicker. Bitcoin is not controlled by any government or central authority. It's decentralized, meaning it operates independently of a central bank. This unique feature gives Bitcoin its intrinsic value and appeal. Now that we've grasped the basics of Bitcoin, let's move on to understand ETFs. So, what exactly is an ETF? Well, let's untangle this financial jargon together, shall we? ETF stands for Exchange Traded Fund. This might sound like something straight out of a Wall Street tycoon's playbook, but it's actually a straightforward concept. An ETF is a type of investment fund and exchange-traded product, designed to behave like a chameleon in the financial jungle. Let's break this down a bit. An investment fund is simply a pool of money contributed by many investors. This fund is then used to buy a variety of assets, which could include stocks, bonds, or commodities. The beauty of an investment fund is that it allows investors to diversify their portfolio without having to buy each individual asset. Now, the exchange-traded part of an ETF means that it's traded on a stock exchange, just like individual company stocks. The price of an ETF share fluctuates throughout the trading day as the shares are bought and sold on the market. This is a significant characteristic that differentiates ETFs from mutual funds, which are only priced at the end of the trading day. But what makes an ETF special is its chameleon-like nature. An ETF is designed to track the performance of a specific index, like the S&P 500, or a sector like technology or healthcare. It does this by holding a basket of assets that mirrors the composition of that index. So if you invest in an ETF that tracks the S&P 500, you're essentially investing in the performance of the 500 largest companies in the US, without having to buy each individual stock. In essence, ETFs offer a way for investors to diversify their portfolios and participate in a wide range of markets without the need to invest in each individual asset. They're flexible, accessible, and can be a powerful tool in your investment toolbox. Now that we've got a basic understanding of both Bitcoin and ETFs, let's see what happens when these two concepts merge. So, what exactly is a Bitcoin ETF, you might ask? Well, let's break it down. A Bitcoin ETF, or exchange-traded fund, is essentially a type of investment fund and exchange-traded product that is designed to closely follow the price of Bitcoin. This means that investors can gain exposure to the price movement of Bitcoin without the need to directly purchase, secure, or store the cryptocurrency themselves. Imagine it like a mirror reflecting the price of Bitcoin. As Bitcoin's value goes up or down, so does the value of the Bitcoin ETF. It's a way of bringing the pioneering world of cryptocurrency into the more traditional realm of investing. It's like having your cake and eating it too, enjoying the potential profits of Bitcoin's price movements without dealing with the complexities and risks of handling the digital currency directly. Sounds simple, right? But why would anyone choose a Bitcoin ETF over simply buying Bitcoin? Why would an investor consider a Bitcoin ETF instead of buying Bitcoin directly? Well, there's a handful of reasons, and they all boil down to three key advantages: simplicity, accessibility, and safety. Let's break these down, shall we? Firstly, simplicity. Bitcoin ETFs simplify the process of investing in Bitcoin. Instead of setting up a digital wallet, figuring out how to buy Bitcoin, and then managing a private key, all you need to do is buy a Bitcoin ETF through a brokerage account. Just like any other ETF or stock, it's a straightforward process that most investors are already familiar with. Next up, accessibility. Bitcoin ETFs are traded on traditional exchanges, making them accessible to a wide range of investors. Whether you're a seasoned trader or a first-time investor, you can buy into a Bitcoin ETF. This is a stark contrast to buying Bitcoin directly, which may require jumping through more hoops and dealing with unfamiliar platforms. And lastly, safety. Bitcoin ETFs mitigate some of the risks associated with owning Bitcoin directly. If you own Bitcoin, you're responsible for its security. If your private key gets lost or stolen, your Bitcoin is gone for good. But with a Bitcoin ETF, you don't have to worry about hacking or theft. The ETF provider is responsible for the security of the Bitcoin they hold, which often means professional-grade security measures are in place. In addition to these, Bitcoin ETFs also offer the benefit of diversification. They allow investors to gain exposure to Bitcoin without having to put all their eggs in one basket. Instead, they can spread their investments across a range of assets, including Bitcoin, thereby minimizing risk. So there you have it. Investing in Bitcoin ETFs is a simpler, more accessible, and safer route to gaining exposure to Bitcoin. It's no wonder they've gained such popularity among investors. While there are clear advantages, Bitcoin ETFs also have their downsides. But we'll delve into that in the next scene. Stay tuned. It's not all roses with Bitcoin ETFs. What are the risks involved? While Bitcoin ETFs offer a convenient way to gain exposure to Bitcoin without the need to hold the cryptocurrency directly, they're not without their drawbacks. One of the most prominent downsides is the lack of actual ownership. When you buy shares in a Bitcoin ETF, you don't actually own any Bitcoin. Instead, you own shares in a fund that owns Bitcoin. This means you won't have the private keys to your Bitcoin, and therefore, you won't have the ultimate control over your investment. Another potential downside is the possibility of mispricing. Unlike traditional ETFs that track a basket of stocks, Bitcoin ETFs track a single asset, and that's Bitcoin. Because Bitcoin's price can be quite volatile, there's a chance that the ETF's price might not accurately reflect the underlying value of Bitcoin at any given moment. This mispricing risk can expose investors to unexpected losses. Fees are another factor to consider. Like all ETFs, Bitcoin ETFs come with expense ratios, which are the fees charged by the fund manager for managing and operating the ETF. These fees can eat into your returns over time. While they might seem small at first glance, they can add up, especially if you plan to hold your investment for a long time. Lastly, it's worth noting that Bitcoin ETFs, like all investments tied to Bitcoin, are subject to the overall volatility and unpredictability of the cryptocurrency market. This means that while there's potential for high returns, there's also a significant risk of loss. In essence, it's crucial to remember that while Bitcoin ETFs offer a more accessible way for many people to invest in Bitcoin, they do come with their own set of risks and drawbacks. As with any investment, it's important to do your homework and understand what you're getting into. It's important to balance these potential downsides with the benefits when considering investing in Bitcoin ETFs. So, are Bitcoin ETFs the future of cryptocurrency investing? That's the million-dollar question, isn't it? We've taken you on a journey today, from the birth of Bitcoin to the emergence of ETFs. We've explored the benefits of Bitcoin ETFs, such as their ability to provide exposure to Bitcoin's price movements without the need to directly own the digital asset. But we've also delved into the downsides, like the potential for market manipulation and the fact that ETFs don't offer the same level of control as owning Bitcoin directly. It's clear that Bitcoin ETFs are a significant development in the cryptocurrency world. They're opening up opportunities for more people to get involved in this fascinating space. But like with any investment, it's crucial to do your homework. The crypto world can be thrilling, but it's also filled with ups and downs. Remember, the world of cryptocurrencies is exciting but also volatile. Always stay informed and invest wisely.